I want you to imagine a very specific scenario for a second.
Okay.
You wake up, you pour your morning coffee, and you grab your phone to check your brokerage app. Just completely normal routine.
Right, just checking the markets.
Exactly. But today, when you open it, the entire global financial board is just violently shaking. I mean, your portfolio, the broader indices, commodity prices, everything is flashing red and green in these wild, unpredictable swings.
That is a terrifying sight for any retail investor.
It really is. And you quickly realize this sweeping global tremor, it's all being caused by a single, highly localized event on the exact opposite side of the world.
Yeah, it really is the ultimate illustration of how fragile our interconnected systems actually are.
Yeah.
I mean, instead of a theoretical butterfly flapping its wings, we're looking at a very severe geopolitical shockwave rippling right through the global economy.
And to understand that shockwave, we have pulled together a really diverse stack of sources for today's deep dive. We're looking at rapid-fire commodities data, the latest analyses from the private credit markets, and some breaking geopolitical reports.
A lot of ground to cover.
It is. But our goal is to synthesize all of this information to show you how a physical spark in the Middle East is creating a global economic fire. And more importantly, we're going to break down the actual mechanics of this domino effect and what it means for you, the retail investor, who's just trying to manage your portfolio without getting burned.
Right.
Okay, let's unpack this. We have to start with the physical trigger, which is this breaking news out of the Middle East. 3 commercial ships have been attacked in the Strait of Hormuz.
Yeah.
But the detail that is causing sheer panic across trading desks is the phrase unknown projectiles.
Yeah.
It seems like that ambiguity is the core issue here.
It is. That is entirely the crux of the market's reaction right now.
Yeah.
Because, financial markets are actually incredibly efficient at pricing in bad news.
Right. They like predictability, even if it's bad.
Exactly. If a known state actor announces a blockade, analysts can just run the numbers, project the shipping delays, and adjust asset prices accordingly. But they cannot price in a question mark.
Wow, yeah. That makes sense.
Right. When a projectile is unknown, it basically means you don't know the antagonist's capabilities.
Yeah.
You don't know their ultimate goal. And you certainly do not know what the retaliation will look like.
So the models just break down.
Completely.
Yeah.
That ambiguity just shatters standard risk models and transforms what could be a regional incident into a full-blown global economic crisis.
Well, let's talk about the geography for a second, because the location is just as critical as the ambiguity, I think. The Strait of Hormuz is essentially the main artery of the global energy supply.
Oh, absolutely.
We're talking about a maritime choke point that handles roughly a fifth of the world's total oil consumption. So when something threatens that specific corridor, it's basically the equivalent of pinching a vital artery. The global economy immediately starts losing oxygen.
And the physical reaction in the commodities market reflects that exact loss of oxygen. I mean, we saw the price of Brent crude oil spike to $105 a barrel almost instantly.
Instantly. It wasn't a gradual climb at all.
No, not based on shifting supply and demand forecasts or anything like that. The chart just went vertical.
The velocity of that move is just staggering to me, a 50% jump in just 7 days. If you look at the pricing chart from last week compared to this week, it literally looks like a sheer cliff face.
What's fascinating here is that the geopolitical tension in that region, particularly between the United States and Iran, is a known historical constant.
Right.
Yeah, that's been there for decades. Exactly. The market has lived with that baseline risk forever. However, the sudden unexplained nature of these specific attacks just threw all historical precedent right out the window.
Because of the unknown factor.
Exactly. When the market doesn't know who fired the shot, it defaults to pricing in an absolute worst-case scenario overnight. So that 50% jump, that's just the mathematical expression of sheer panic.
Okay, so the artery is pinched, and the oil markets are blazing, which threatens to trigger a systemic freeze across the board. And that naturally brings us to the first responders.
The central banks.
Right. When the global economy faces an immediate critical threat, the central banks step in. But let's clarify what that actually looks like for you listening. Because according to our sources, central banks injected $18.5 billion in emergency liquidity into the financial system.
Yes.
Now, when we say liquidity, we don't mean they are handing out briefcases of cash to regular people, right?
No, not at all. Emergency liquidity means the central banks are basically offering short-term, ultra-low interest loans to commercial banks.
Okay, so just keeping the banks afloat.
Right. Think about it from the perspective of a major bank. If oil prices double overnight, that bank knows that manufacturing companies, shipping firms, airlines, they're all suddenly going to struggle to pay their bills.
Right, their cost just skyrocketed.
Exactly. So the bank gets scared. And it stops lending money to other banks and businesses because it wants to protect its own cash reserves.
And if every bank does that simultaneously?
The entire credit system freezes. Businesses literally cannot make payroll. So the central bank steps in and says, look, we will provide you with guaranteed cheap capital so you do not stop lending.
Wow. And to give you a sense of how serious this specific intervention is, financial analyst Jose Luis Cabal actually reviewed this maneuver and explicitly compared it to the interventions during the dot-com bubble burst.
That is a very heavy comparison.
It really is. During the dot-com crash, trillions of dollars in paper wealth just evaporated, which threatened to bankrupt financial institutions, and that forced central banks to flood the zone with cash. So Kaba is essentially saying the institutional fear right now is on that same exact level.
Yeah.
They are trying to avert a total systemic collapse.
And, the comparison to the dot-com era is highly instructive. Because in both cases, the central banks are acting as the ultimate backstop. They're trying to ensure that a severe shock in one sector, whether it's, overvalued internet stocks in the year 2000 or a geopolitical oil crisis today, they want to make sure it doesn't drag the entire banking system down with it.
But wait, I have to push back on the effectiveness of this strategy for a second. We are talking about an $18.5 billion injection, but analysts are already noting that this emergency support is starting to slow down.
Yes, the effects are waning.
Right. And more importantly, treating a physical supply chain issue with a financial band-aid just seems incredibly risky. I mean, if ships cannot physically pass through the Strait of Hormuz, all the printed money in the world isn't going to conjure physical gasoline into existence.
No, it is not.
Doesn't pumping billions of dollars into the banking system to counteract an oil shock just run the risk of aggressively reigniting the inflation that retail investors have spent the last 2 years battling?
You have hit on the exact tension keeping institutional investors awake at night right now.
Okay.
Central banks are essentially just buying time.
That's all it is.
Yeah. An emergency injection stops a panic today. It ensures the financial plumbing keeps working.
Yeah.
But you are entirely correct. You cannot print physical commodities.
Right. You can't print oil.
Exactly. If the underlying supply issue persists, that excess liquidity sloshing around the banking system, combined with scarce, extremely expensive energy, is just a textbook recipe for severe inflation.
So the underlying problem is physical, but the immediate response was purely financial.
Precisely.
Okay, so the central banks are plugging the holes at the institutional level, but while they're doing that, what are actual retail investors and mutual funds doing with their own portfolios? Because the data in our sources shows a massive reshuffling of capital. In times of severe crisis, we see this textbook psychological shift known as the flight to quality.
Yes, that is the financial term for capital preservation. Basically, investors aggressively sell off assets they perceive as risky, volatile, or highly illiquid, and they flood their capital into safe haven assets.
They're just looking for a secure harbor to anchor their wealth until the storm passes. Let's break down where that money is actually hiding, because the list of safe havens includes the classics, but also a few modern twists that I think require some explanation. We are seeing a huge rush into the US dollar, which remains the ultimate global reserve currency.
Right, standard move.
And money is also flooding into gold, the historical hard asset. But then we see capital flowing into the perceived safety of large-cap S&P 500 companies. Why are investors looking at the stock market as a safe haven during a global crisis?
Well, it comes down to balance sheets. Investors are not buying into the S&P 500 right now expecting massive growth.
Okay.
They are targeting the mega corporations like the tech giants and major consumer conglomerates because those specific companies hold billions of dollars in cash reserves.
Oh, I see.
The logic is that these corporate fortresses have the sheer financial gravity to weather an extended period of high inflation and expensive oil, whereas a smaller mid-cap company might literally be driven into bankruptcy.
That makes a lot of sense. We're also seeing significant capital flow into Bitcoin, which is fascinating to me. Historically, Bitcoin is viewed as a highly volatile risk asset.
Very volatile, yeah.
So the fact that capital is fleeing to a digital currency alongside centuries-old gold suggests that investors aren't just scared of an oil spike. They are showing a deep distrust in the stability of the traditional banking system itself. They want an asset completely divorced from central bank monetary policy.
That is a really critical observation.
Yeah.
The inflow into Bitcoin during a geopolitical crisis highlights a rapidly shifting perception among both retail and institutional investors about what actually constitutes safety.
Right.
But to truly understand the current market fragility, we can't just look at the inflows. Every single dollar flowing into gold or large cap stocks had to be sold out of something else.
Here's where it gets really interesting. If you want to know what the market is genuinely terrified of right now, you have to look at where the money is bleeding from. And the data shows it is hemorrhaging from alternative credit markets.
Hemorrhaging is the right word.
Yeah. Blackstone's private credit fund, known as BCED, was just hit with a record $3.8 billion in withdrawal requests. $3.8 billion.
It's massive.
To understand why this is so alarming, think of a private credit fund like a crowded movie theater with only one very small exit door. The movie playing on the screen represents the fund's assets, which are loans tied up in private companies that are not publicly traded.
That movie theater analogy perfectly illustrates the liquidity trap we're talking about here. Private credit funds do not hold stocks that can be sold on a public exchange in milliseconds.
Right, it's not like selling shares of Apple.
No, not at all. They hold complex, direct loans to mid-sized businesses. Those loans are highly illiquid. You can't just cash them out on a Tuesday.
Right. So when someone in that theater smells smoke, in this case, an oil crisis, everyone panics and rushes the single tiny exit door all at once. The fund simply cannot sell those private loans fast enough to hand everyone their cash back through that small door.
And that is the hidden fragility of the alternative credit market. When retail and institutional investors demand $3.8 billion back simultaneously, it forces the fund managers into a corner.
What do they do?
Well, they may have to gate the fund, meaning they legally halt withdrawals entirely, or they might be forced to sell off assets at a steep discount just to generate the cash. Either scenario absolutely destroys investor confidence and accelerates the wider market panic.
It becomes a self-fulfilling prophecy. Now, this massive movement of capital fleeing private credit and running to safe havens, it isn't happening in a vacuum. It's actively reshaping the global economy, but it's doing so in highly unequal ways depending on where you look. Then dive into the global scorecard, starting with Europe. According to the research, Europe is currently bearing the absolute brunt of this crisis.
Yeah, Europe's vulnerability is structural. It stems directly from its reliance on imported energy. When the price of oil spikes, that cost travels so rapidly through the European economy.
Because they have to import so much of it.
Exactly. A barrel of oil jumps in price. Immediately, the cost to run a German chemical plant or an Italian manufacturing facility skyrockets. Those factories are forced to pass the costs down the supply chain, which eventually hits the supermarket shelves.
And that just crushes the consumer.
It crushes consumer purchasing power. Consequently, we are seeing European stock markets taking severe hits as investors price in a continent-wide slowdown in consumer spending.
Compare that to the United States. On paper, the U.S. economy appears much more insulated. I mean, the U.S. is a major domestic energy producer, which acts as a partial buffer against the Strait of Hormuz shock.
Right, they aren't as reliant on imports.
But the sources indicate that despite that structural advantage, capital deployment in the U.S. is largely paralyzed. The hesitation isn't just about oil, though. It's deeply tied to domestic uncertainty, specifically surrounding the upcoming election cycle and the looming threat of new trade tariffs. So while the U.S. isn't sinking like Europe, it is nervously treading water.
Exactly. The U.S. is experiencing a paralysis of capital. Corporations are hesitant to build new factories or announce major acquisitions when they cannot accurately forecast what the regulatory or tax environment is going to look like 6 months from now.
Makes sense to just hold on to your cash?
Right. Meanwhile, if we look at Latin America, the economic reactions are wildly divergent.
It really is a study in contrast down there. On one hand, you have a surprisingly strong Mexican peso. Mexico is currently benefiting from nearshoring, which is basically companies pulling their supply chains out of geographically risky areas and moving them closer to the U.S. border.
Right, trying to shorten the supply chain.
Exactly. But just a few thousand miles south, Argentina is suffering immensely. A global crisis naturally strengthens the U.S. dollar as a safe haven. But for a country like Argentina, which holds massive amounts of dollar-denominated debt, a stronger dollar makes servicing that pre-existing debt exponentially more expensive. It just worsens their chronic inflation.
It really demonstrates how a single macroeconomic event acts as an accelerant for pre-existing regional trends. The strong get a slight buffer, while the fragile are pushed completely to the brink.
Which brings us to a massive piece of this global puzzle, China. Beijing recently announced a growth target of 4.5 to 5%. To put that in historical context, that is their lowest growth target in decades.
Decades, yeah.
The source material describes Beijing as essentially buckling its seatbelts for an incoming storm. And when you look at the mechanics, it makes perfect sense. We just talked about how Europe's energy costs are crippling consumer spending. Well, who manufactures the consumer electronics, the appliances, and the goods that those European consumers are no longer buying?
If we connect this to the bigger picture, you are mapping out the precise arteries of the global supply chain. A regional conflict in the Middle East is no longer isolated.
Everything is connected.
Completely. When European consumers stop spending because their energy bills have doubled, factory orders in Shenzhen plummet. Chinese manufacturers reduce output, which means they buy fewer raw materials from Latin America and Africa. A blocked strait in the Middle East forces a factory worker in China and a consumer in Europe to simultaneously tighten their belts.
It's a humbling reminder of how tethered we all are. The inflation data in the US, the consumption data in Europe, and the manufacturing data in Asia are all ultimately linked to the free flow of energy through a 21-mile wide stretch of water.
It really puts it in perspective.
It does. So bringing all these complex threads together, the initial geopolitical spark, the ensuing oil spike, the scramble by central banks to inject liquidity, and the frantic flight of capital away from private credit, what is the actual psychological state of the global market right now? How is it digesting all of this simultaneous chaos?
The most accurate way to describe the current market psychology is that it has developed severe, almost impenetrable tunnel vision.
Meaning investors are entirely fixated on the threats and completely ignoring the fundamentals.
Precisely. In a healthy, functioning market, investors weigh a complex variety of inputs. They look at corporate earnings, consumer credit health, employment numbers, innovation, all of it. But right now, market participants are actively ignoring positive data.
Like what kind of data?
Well, we are seeing incredibly solid corporate earnings reports from certain sectors. We are seeing pockets of resilient consumer spending in various regions. Normally, those data points would trigger a wave of buying and drive stock prices up.
Right.
But in this environment, the market is utterly indifferent.
Because it is entirely consumed by the macro-level fire. According to the analyses we're reviewing, there are quite literally only three variables on the market's dashboard right now. Number one is the daily price of oil. Number two is the flow of central bank liquidity. And number three is the minute-by-minute geopolitical risk coming out of the Middle East. Everything else has just been muted. Fear is officially commanding a higher premium than actual corporate profits.
And that creates an exceptionally dangerous equilibrium for anyone trying to navigate the financial landscape. When sheer fear and macroeconomic anxiety dictate capital allocation more than the underlying fundamentals of the companies themselves, the markets become highly irrational and unpredictable.
So what does this all mean for the everyday listener, the retail investor who just wants to understand how to view their own 401k or brokerage account amidst all this noise? How do we bottom line this bizarre economic reality?
This raises an important question, and I want to leave you with a rather chilling thought exercise derived directly from analyzing these converging events.
Okay, let's hear it.
If we step back, we are currently observing a global financial market that is being artificially propped up by two distinct pillars: the sheer panic driving capital into safe havens, and the massive multi-billion-dollar emergency cash injections from central banks acting as a floor. The vital question you must ask yourself when evaluating your portfolio's true strength is this: if the geopolitical tensions miraculously resolve tomorrow and the central banks subsequently withdraw that emergency liquidity, what fundamental foundation is actually left underneath to hold the market up?
Wow. That is the pivotal question. If the fear evaporates and the emergency backstop is removed, are we going to find a genuinely healthy, functioning global economy underneath all that scaffolding? Or are we just going to find empty space? That is the specific lens of fear versus fundamentals that every retail investor needs to adopt right now. The next time you open your brokerage app and see the entire board shaking, remember that the violent swings are not always a reflection of what a specific company is earning or building. Sometimes it's just the global market having a physical reaction to a pinched artery thousands of miles away. It's all connected, and understanding those connections is your best defense against the panic. Thanks for taking this deep dive with us today. Keep your eyes open, watch the fundamentals, and we will catch you on the next one.